Good morning and welcome to today's live technical analysis. Once again, and as always, we will be starting off with the euro against the US dollar. As you can see, the euro appears to be moving in a relatively sideways fashion. Some of you might be pointing out that the RSI is near 60, which does imply some bullish market tendencies. However, if you look at the Bollinger Bands in addition to the moving averages, they appear to have smoothened out, implying low market volatility. As such, we would still maintain a sideways bias between the S1 and R1 level. For example, if it reaches up to R1, we would not be surprised for there to be a correction to the mid range or perhaps even down to S1, with the pair remaining between the sideways moving channel defined by the S1 and R1 support and resistance levels, respectively. In terms of monetary policy, we're noting that ECB policymakers appear to be set on a June rate cut. Market expectations, so Euro OIS currently implies, if I'm not mistaken, a 92% probability for a 25 basis point cut by the ECB in their next meeting. Such a scenario could weigh on the euro, as the US dollar may appreciate following the hawkish comments made by Minneapolis Fed President Kashkari earlier on today. So with the euro, well, with the ECB potentially cutting earlier than the Fed, we might see the pair move in a downward trajectory. For now, however, it appears that the euro is holding its own against the US dollar. In terms of financial releases, we have the HICP rates, the preliminary rates for the Eurozone as a whole, Germany and France. In tomorrow's Asian session, we're noting Australia's CPI rates, which are set to be released. For the Aussie, if we can locate it on our chart, so on the daily chart, you can see that the Aussie did break above R1, so 0.6635, but failed to break above R2, forming a double top and then moving lower. The RSI, it's still at 58, so close to 60, implying some bullish tendencies. We might see the pair attempting a third attempt to break our new R1. Old, older one actually could turn to support, but we might need to readjust our support level. Before we move on to the Aussie, however, let's finish off with the euro and the US dollar. For the US dollar on Friday, we have the core PCE rates. Therefore, it could all change at the end of the week. Sideways, perhaps, until the release of the Eurozone's CPI rates, HICP. And then on Friday, with the core PCE of the US dollar, we might see it reversing trajectory. It depends, of course, on the financial releases. In terms of monetary policy, as we've said, ECB policymakers appear to be taking a more dovish approach, so implying cuts, thus the market expectation of a 25 basis point cut in June. For the euro, for the dollar, however, appears to be slightly more hawkish, which is why we would maintain a sideways bias and not a bullish. Onto the US dollar against the JPY. Japan CPI rates came out earlier on today. So the BOJ's core CPI rates, to be precise, they came in at 1.8, if I'm not mistaken, which is lower than expected. The lower than expected CPI rate might be a bit of a concern for the BOJ, who abandoned its ultra loose monetary policy on the prospects of achieving sustainably 2% inflation. So lower than expected rate is not good for the BOJ. But it appears that the bulls may have not moved the pair higher. There's a bit of a concern, as this was the level upon which the government intervened, as you can see at the beginning of April. Thus, if it does move higher, the question is how much, and we might be seeing some hesitancy from the bulls. From a technical point of view, though, you have the RSI at 60. It's resting on S1, so it would maintain a slight bullish outlook, but perhaps maximum up until R1 at 158.30. For the Aussie, we'll note that a bit. So USD CAD moving in a downwards fashion. It did break our downwards moving trend line, but the RSI is still close to 50, 45. One could say it might be moving a relatively sideways fashion below S1. For the Euro and JPY, we're keeping our support and resistance levels the same. USD CAD, I'd bring my S1 slightly lower, reflecting this swing low at 136 point, well, at 1.360. Nice round figure as well. So psychological support level. Then readjusting to this old low for S2, 1.3525. And then for S3, we're going to be bringing that lower as well. or we could simply eliminate that line there. So we can use this from a more macro perspective now, and we can keep our old support level at 1.3415. So we have S1, S2, and S3. In terms of resistance, we would have to reflect this most recent high at 1.3725, I would say. 27, 1.32, 1.3727, because at 25 it's within the candles. We like to take the high. So 1.3727, that's our one. Would still maintain a bearish outlook. Is a bit peculiar. You do have the Bollinger Bands, which are slightly tilted, but the moving averages, the 50 and 100, appear to be smoothing out. Then you have the RSI at 50. I wouldn't be bearish. I'd maintain a neutral outlook for the pair, so sideways bias between S1 and R1. But if it does break below S1, immediately switching for a bearish outlook. Onto the British pound, we're noting the elections are set to take place. We have about a month or so up until those elections occur. Currently, according to Apollo by Politico, the Labour Party, which is the opposition party, is leading the polls by about 20%. So 20 points. That's a big gap for the Conservatives to fill. So personally, I think the reason as to why Prime Minister Sunak announced that they would be going for elections, a general election, is because of the CPI rates. They came in at 2.3%, which is about nearly a percent lower than the previous reading. Now, I think that will be the focus of the incumbent government's campaign. So, using inflationary pressures, and I think they're trying to get ahead of any potential economic downturn later on in the year. So, I think they're rushing it. I think their main focus will be the CPI, so inflation, the government claiming that they've reduced inflationary pressures, etc., etc. So, I think that's what they're going to be campaigning on. But based on the polls, we might see Labour entering 10 Downing Street. For now, the pair appears to be moving in an upwards fashion. RSI at 70, bullish market sentiment, would have to break above R1 for our bullish outlook to continue. If it breaks below S1, we would switch for a bearish outlook, taking aim for S2 at 1.2560. If it does not break above R1 and then fails to break below S1, we would maintain a sideways pass between the aforementioned support and resistance levels. Onto the Aussie, we're also noting China's MPS manufacturing PMI figures, which are set to be released later on this week. We've said this on numerous occasions. Close economic ties between Australia and China. Thus, financial releases stemming from China could also influence the Aussie as well. For now, from a technical point of view, RSI is at 60, implying some bullish market tendencies. Our support and resistance levels need to be readjusted. So for support, I take this recent low at 0.660. So this would be my new S1. I'd have to readjust my old S1, bringing it slightly lower, so it's not too close to my new S1. So around here. Now I'm taking this support level. As you can see, this bullish candle came up, found sellers, but managed to maintain around this level and moved higher. We could actually readjust our support level even lower, reflecting this very nice wick that came back down. Second, validating it as a genuine support level before moving higher. So this would be our new S2, 0.6515. That is RS2. We would need to readjust S3 as well. So this becomes S1. For R1, we could keep our old R2, and then we're putting back into play our old R3. So we have S1, S2, And then S3 can be brought slightly higher. Note where the downwards moving trend line ended and then moved in a relatively sideways fashion before moving higher, having formed the long term upwards moving trend line. So that's my S3, 0.64. And now we have to readjust our resistance levels. R2 becomes R1, R3 becomes R2, and then we will place our new R3 level. It becomes R2, and this becomes R3. Now we are on the 4 hour time frame, so we could maintain a sideways bias. As you can see, it's not moving that much higher. It's still respecting the Bollinger Band. It's not overbought, it's not oversold. But if you look at the candlesticks, they're small in size, which implies there are some bullish tendencies, but it might be minimum. You could also note that there is an upwards moving trend line, which is about to be broken, thus further validating our neutral outlook for the particular pair. Onto oil. Oil is continuing to move in a sideways motion. So this is our daily chart. We had noted this sideways moving channel. This rectangle, as you can see, in orange. Bollinger Bands appear to be flattening it out. RSI at 50, neutral market sentiment between 79.50 and 76.65. So sideways bias for oil. Onto gold. Now, gold is a very interesting story. Formed new all-time highs last week, as you can see, near 2430, slightly higher, but we're taking the opening and closing of the bullish and bearish candles. It's respecting our oldest one level of 2,355, which now becomes our new R1 level. So it is support and resistance. We would maintain a bearish outlook for the precious metal as it has broken below our support, now turned to resistance. Furthermore, the RSI is at 50, but if you note from where it came from, so it came from 70 down to 50, implying that the bullish momentum may be fading away. As such, we might be seeing the bears now in control of the precious metals price. For our bearish outlook to continue, however, I would like to see it and would require it breaking below 2,275 on the daily time frame. If we drop down to the 4 hour, you can see that it's respecting the 2,355 support level, support turn to resistance. So correction R, RSI came back up to 50, but it's now at 39, so below 40, implying a bearish market sentiment. I would not be surprised to see the precious metal temporarily take aim for this intermediate support level of 2,307. So correcting higher before continuing on its descent. It's breaking below the mid-range of the Bollinger Bands, further supporting our hypothesis for a bearish outlook for the precious metal. Now, if it stays in between the intermediate S1 and R1, then you could maintain a sideways bias. Once again, the precious metal is influenced by the US dollar's price. So if the dollar strengthens, we might see the precious metals price moving in a downwards fashion. Technicals, though, do support a bearish outlook for the particular pair, for the precious metal on a 4 hour time frame and on a daily time frame as well. So, from more macro perspective, we would be bearish for the precious metals price. So, we have R1, old R1 becomes R2, and so on. 2,500 hypothetical resistance level becomes R3. You can keep 2,575 as well, just in case it does break above R1. Support daily, but then it would be too far away. On the daily time frame, I would keep my S1 level at 2,275 if we are using the daily. So using it for about a week or a month, this might still be valid. S2 becomes 2,200, and now we're on the hunt for S3. So here is Nice. It's too close. It's fairly close to S2, however, but it will have to do. Otherwise, it'd be too far away from S2. So we are taking 2,135 for our support level at S3. This becomes S3. We will be dropping down to the 15-minute time frame as well. So this is support and resistance onto the 15-minute. As you can see, let's just make this slightly larger. Resistance, lower lows, lower low. This is a higher high. Still bearish. RSI is at 40. Bearish tendencies. Took out the liquidity nicely here. So everyone that went short with a stop loss, coinciding perfectly with these two wicks. So this is a resistance level on the 15-minute time frame. Next potential target could be 2,335. Lower than that, one could potentially aim for 2,325. So this is on the 15-minute time frame. Resistance would be at 2,344. So at this most recent high, perhaps target one, first one could be 2,335. Lower than that, 2,326. If it does break above temporary resistance at R1, next target could be our 2,355 resistance level. But this is the 15-minute time frame, and we prefer to use the 4-hour. Nonetheless, we do have our support and resistance levels. Dow Jones 30 actually resting on S1, 39K, so 39,140 is at 50, so sideways bias between S1 and R1. Wouldn't be bullish just yet. It's broken our smooth trend line, came back down to support, might correct between S1 and R1. S&P 500 resting on our old R2, might be taking in for R3. Still bullish outlook for the S&P 500, which is a divergence when looking at the Dow Jones 30. Nasdaq bullish outlook clearly. RSI is at 70, higher and higher. New all-time high almost needs to break this wick. Target is 19,300. All point towards a bullish outlook for the Nasdaq, but a bit of a concern with the Dow Jones 30. I would place more emphasis on the Dow Jones 30, then seeing the reaction on the S&P 500, and lastly the Nasdaq. Boeing, we would have maintained the bullish outlook, yet news came out from the company, lower orders dropping 6%, if I'm not mistaken, dropping below. We now reemerge with our bearish outlook. Things were looking good for about a week, but then once again, as usual, Boeing moving in a downward fashion, breaking below S1 of 176.60. S2 is now at 158.35. Airbus resting nicely above S1 at 159.0. Nvidia 1070 was our hypothetical resistance level that we had placed. It's just below that. Still bullish for the company. Cap out. Breakaway cap. Might move higher. Target could be potentially 1200. Apple moving higher, correcting lower. Still RSI near 70. Upward moving trend line. Bollinger Bands moving in upwards fashion. No crossover between the moving averages. Also imply a bullish outlook for the company's stock price. Netflix bouncing off R2, 631. Bullish outlook as well. Slight concern that it's dropping back down to 70, but this was overbought, so it does make some sense. Tesla, sideways bias between 168.77 and 196 as R1. ExxonMobil breaking below 113.55, which was our support and resistance level, turned to support, now turned back to resistance. R3 now becomes 122.80. R2 can be 119.60. R1 114.15. S1, S2, and S3 remain the same. 109.10, 104.78, and 100.60. UBS moving higher and higher, so it's recovering, taking aim for old support and resistance 31.33. Kiwi breaking above R2, bullish outlook for the particular pair, taking aim for R3, which was 0.6215. This becomes support. And then old high, too close to R1. So taking this wick of this lower high, 0.6285. And then for R3, let's zoom in so you can see what I saw as well. I am taking this instead of something higher for one particular reason. Yes, you could say this is a resistance and this as well. But note the price action. Candles, accumulation, inverted hammer, up, bearish candle, came back up, found resistance. So this would be my R3. If it does come up and aims for R3, then maybe we could readjust our R3 slightly higher. But for now, 0.6340 is my R3 figure. Bullish outlook for the Kiwi, however. Expecting S1, so resistance turn to support, RSI at 70. Bullish outlook overall for the particular pair. ARM, semiconductor, 114.68 support now acting as resistance. Would slightly readjust that based on what we're seeing. 4 hour. This high 118.12. Support can stay at 103.80 for S1. S2. This old swing low, 94.96. Neutral outlook, so sideways bias between 103.80 and 118.48, so sideways bias. RSI close to 50, smoothing out of the Bollinger Bands and moving averages, implying low market volatility. Disney bearish outlook, breaking below support, bounced off, but could be a market correction. Coca-Cola dropping back below our old R2. Bearish outlook, RSI dipping below 50, close to 40, slightly below at 39. Bearish outlook taking aim for 61.20 potentially. Google still slightly bullish. A bit of a concern that the RSI is now at 58. Might be seeing market correction lower to 170. Might be a bit concerning. Ferrari holding its own between 410 and 428. Sideways bias as well. Intel having bounced off nicely off our support level at 29.78, taking aim for 33.79 potentially. Now, the issue with Intel for someone looking for a bullish outlook is that the RSI is still at 40, so it does imply bearish tendencies. The positive note is that it tried 3 times to break below S1, but it's bouncing off. Now, if we see Intel stock price aiming for 33.79, I would not be bearish. Instead, I would maintain a sideways bias. If it does manage to break above R1 at 33.79, then we could switch for a bullish outlook, potentially taking aim for 37.75. Now, with the potential tariffs being imposed, Intel might benefit in the long run. For now, does not appear to be having any market effect. JP Morgan finding some resistance at 200.45. It is breaking that currently, but I would like to see it make a clear break above before I can turn this from resistance to support. Still, RSI at 56, bullish tendency slightly. If it does form a new higher high, then you would have a higher low, higher high, and another higher high. So might be bullish depending on the way the company stock price moves in today's trading session. Yesterday was a holiday, so it was a bank holiday in the UK and in the US. Amazon moved higher, but the RSI is at 39, so below 40. I would be bearish for Amazon stock price. Old support at 183.25 is now resistance. Target one would be for me 174.0, S2 165.87. Lower than that, we might see some support at 154.40. Once again, this is my own interpretation 154.40. What else can we see today? So we've done the majors, we've done the indexes, we've done the euro. Surprised that the euro is still moving higher based on the comments that we've seen from ECB policymaker Villeroy. JPY makes sense. Bulls are a bit concerned about potential intervention by the government in favor of the JPY. So minimal uptick. Dollar CAD, oil prices past 3 days have been moving higher. And then let's see that's reflected in the CAD as well. So as an oil exporting nation, oil prices moving higher might be beneficial for the loonie as well. Back to gold. Would be bearish. As long as the 2,355 R1 resistance level is respected on the 4-hour time frame, I wouldn't be bullish on gold. We did see gold for a new all-time high, and then we saw a retracement, so moving lower and lower and lower. But it does appear that the bears might have taken over the precious metals price, so its direction. As long as this is validated, I would maintain a bearish outlook down until 2,275 on the daily time frame. See. So what happens there? So we've done Apple, Netflix, Tesla, IBM. If there is anything in particular you would like to see, now is the time to ask. You can have a look, do some technicals, discuss some fundamentals potentially. For the rest of the week, I'd note the US core PEC rates on Friday, which are the Fed's favorite tool for measuring inflation pressures, the revised GDP rate for quarter two of the US, the CPI rates of Australia in tomorrow's Asian session, the CPI rates, the preliminary ones for the Eurozone, so Germany, France, and the Eurozone as a whole. We're getting Germany's first, and then we're getting France's and the Eurozone's the day later. Tomorrow we have the Fed's page book, if I'm not mistaken, in addition to the GDP rate, the advanced GDP rate for Q2. Core PCE. So essentially, it's inflation and GDP this week. GDP for Canada as well on Friday. So we do have some interesting financial releases. It just yesterday and today appear to be relatively muted. I would expect market action, so volatility to pick up tomorrow with the financial releases. For today, it's said to be an easygoing session. Nothing too major is expected to be released today. If we do see something out of the ordinary, then yes, it might have a market impact, but nothing on our calendar for today. So essentially, an easygoing day today. Expecting it to be a bit more interesting tomorrow. So we've done everything. If I'm not mistaken. As Google, Intel, JP Morgan, Reddit, breaking below S1. Uh, we might be seeing a crossover of the 100 moving average above the 200 moving average. Might generate a bull signal. Bullish outlook. Technical is broken below our old support level, which is now resistance. S1 49.45, S2 144.37, and then this old low 38.75 as our new S3. BP recovering slightly, but bulge bands RSI still imply a bearish outlook. Hello, apologies, we had some technical issues. We're now back, but we are reaching at the end of our daily program. So once again, for today, perhaps Australia's CPI tomorrow might be of interest. So AUD USD, some speeches from, if I'm not mistaken, BOE policymakers, ECB, and Minneapolis Fed President Kashkari has already spoken. So that might be a bit of interest. Oil in terms of geopolitics and that of gold, but we're expecting higher volatility to pick up from Wednesday onwards. So for today, we might be monitoring the Aussie, so AUD USD, might be of interest. USD JPY for a potential intervention from the Japanese government. And tomorrow we'll probably go into a technical analysis of, once again, the euro, the major pairs, and if there is a particular stock that one of you would like to ask, so we can have a look at it together from some technicals and an analysis, place some support and resistance levels, then feel free to ask in tomorrow's live technical analysis. Same place, same time. Thank you very much for watching, and I'll see you all tomorrow. Goodbye.
But yeah, possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So, disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of this material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here is our agenda for today. So before we get into Elliott wave theory, I just wanted to do a quick recap on Fibonacci because you can't really get into Elliott wave theory without actually fully grasping your Fibonacci concepts. So because it's been a while since we've done our Fibonacci series, I thought we would spend a couple of slides to talk a bit about our Fibonacci techniques. Then we'll get into Elliott wave theory, look at the different types of waves, and a few shapes. So there are a lot of different shapes, about 50 plus if I'm not wrong, but I'm just going to be going through 3 or 4 in this session. Okay, let's get started with our Fibonacci now. So these are the Fibonacci numbers that we typically use. So if you've been with us before, you would know that we use 4 different types of Fibonacci. We use the Fibonacci retracement, which is the numbers that's in between, so 23.6 to 78.6. And then we have the Fibonacci extension, which is the 127 to 161.8. And then we have Fibonacci expansion, which is the negative 61.8 and negative 27.2. Okay, in this GIF that I've included here, we are just showing you the Fibonacci retracement, which is the most basic form of Fibonacci. Okay, I'm not sure why my projections GIF isn't showing up, but I will go into depth what exactly projections are in the later slides. So firstly, we can look at the retracements that I went through earlier. I mentioned earlier, only consists of a starting point and an ending point. So you can see the point 1, point 2. What's important to note about this is basically just to follow the shape of the chart. So you can see it's pretty clear shape, clear cut shape, and actually for all of the Fibonacci, we highly stress on following the shape of the charts. Next, let's take a look at expansions. So expansions are the negatives of the range of Fibonacci numbers that we use. So if we take a look at the expansions GIF here, you can see we have 3 points that we take note of, one starting point and then an ending point. So for expansions and extensions, these both use the Fibonacci retracements tool on TradingView and on MT4 as well. Only the projections one that requires 3 points, then we use the Fibonacci extension tool. So it's a bit confusing at the start, but basically these 3, we use the same tool, the Fibonacci retracement tool. So we have a starting point here and an ending point. And our third point is just to make sure that we retrace at least 50% of the chart. So typically expansions and projections are used together, and we want to look for a flash kind of shape. So you can see here in the chart, we have this lightning bolt kind of shape, or some people call it like a Harry Potter kind of shape. So that's what you want to look out for when you're using expansions as well as projections. But I'll give you a couple of examples later on. Next, if we take a look at extensions, this is what we call the Nike tick Fibonacci method. So we have a starting point and an ending point, which is the head of the tick. And then it has to retrace at least 100% of the head of the tick to be considered a tick. Obviously, the tail has to be longer than the head. So this is what we're looking for. Extensions, we use the more than 100% values of the Fibonacci range. Okay, let's take a look at a couple of examples in the charts so that's a bit clearer. So here, we have all of the three ranges for you to take note of. So from 0 to 100% is the range of Fibonacci retracements. Then we have the positive Fibonacci retracements, more than 100%. Not included here is the 161.8 as well. So it's important to take note of that if you are using the Nike tick. Next, if you see me looking to this side more, it's because my monitor is on this side. So yeah. And then on the other hand, with the negatives, is our Fibonacci expansions rather. And this is the negative 27.2 and the negative 61.8. So let's start off by looking at the Fibonacci retracement method. So we have the starting point over here and the ending point here. And as you can see, I'm looking at where price has retraced, hence the name Fibonacci retracement. So over here, I've highlighted this area in which price has bounced off of. And this is the 61.8 area. So we take note of this level because price has reacted off of this specific level. So that's an important level for us to take note of. So what we like to do is once we've identified a specific level, because it can get quite messy if you're looking for Fibonacci confluence in which all of the different Fibonacci's line up in the same area. So what we do is once we've identified an important area, we just get rid of the other levels and just solely take a look at this one highlighted number. Here's another example of a Fibonacci retracement. So I have our starting point here, ending point here. My 38.2 is at this overlap support level at the 32544.21 level. So it's an overlap support because we have a swing high. Oh, we have a swing high that has that's at the same level as a swing low. So it's basically where the bulls and the bears respect a specific area. So at this overlap support, we also have the 38.2% Fibonacci retracement that lines up with that area. That's why I've highlighted it here. Okay, another example here. So here I have two levels that I've highlighted to show you guys briefly how we use Fibonacci retracements to support our resistance and support levels. Okay, so firstly, let's take a look at this 61.8 that lines up with my resistance at the 0.92637 level. So at this level, it's obviously a swing high resistance with the swing high highlighted here. And then using our Fibonacci retracement, I've noticed my 61.8 lines up with this level and price has reacted off of it nicely, which is why I've just kept that level. And then I pull out another Fibonacci retracement from this swing low to this swing high here in order to find a retracement level that lines up nicely with my swing low support. So this is a multiple swing low support with 1, 2 swing lows lining up nicely. This is at the 0.91614 level. Okay, so and then once again I can see that my 61.8% lines up nicely with that same level, which is why I've highlighted this area here. Okay, so I hope that's been pretty clear on Fibonacci retracements. Pretty straightforward method to use. So, but let me know if you guys have any questions throughout the webinar. Okay, if there are no questions, we can move on to our next Fibonacci recap. Okay. Okay, so the time frame, we typically will analyze on either the 1 hour or 4 hour time frame um, because the shorter time frames, like the 5 minute, 15-minute time frame, those tend to be a little bit more noisy. So we stick to the middle for 4 hours or 1 hour, depending on how clear the charts are. But it really depends on your own trading strategy. So if you are a swing trader, you might prefer a longer time frame. If you're scalping, you might prefer a shorter time frame. So it really depends on you, but we just stick to the middle whenever we are analyzing. Okay, so next, let's take a look at Fibonacci expansion. So once again, expansion, we are looking for a flash symbol or lightning bolt symbol. So you can see here, in the example I've included, we have a starting point over here at point 1, and then at point 2, we have the ending point. Point 3 is where we then start to analyze whether price has retraced at least 50% in order to form that flash or zigzag shape. So in this example, price has retraced up to the 61.8% level. So that's how I know it's more than 50%, definitely more than 50%. So I can use it to predict or to forecast where price is going to come down to. So I can see here, at my last arrow, I'm expecting price to come down to this negative 27.2% level. And I'm expecting price to bounce off from this level. And we've included support because it could be a possible support level. Okay, so for Fibonacci expansions, we are looking at the negatives, mainly negative 27.2 and negative 61.8. Okay, and then we can see the outcome of what we have analyzed in the previous slide. At the negative 27.2 support level, price really did bounce up nicely off of the Fibonacci retracement. Okay, and then a pro tip that we have included here is that price usually does come back to its ending point, which, as you see in the beginning, at point number 2, that's where our ending point is at. Okay. Next, we're looking at over here we're looking at the Fibonacci extension. So like I said, this is a really quick, just kind of recap before we dive into Elliott wave theory. But I just thought that in order to really understand Elliott wave theory, you really need to have your Fibonacci techniques in check. So it's been a while since we've done our Fibonacci series, so we're just gonna do a quick recap here. But if you have any questions, feel free to let me know. Okay, so next we're moving on to our Nike tick or Fibonacci extension. So the extensions we're looking at are the 127.8, I think, and the 161.8. Okay. Um, Here you can see very clearly that we have an upright Nike tick. You can see exactly the shape of the tick, but it can also possibly be upside down. I think I have examples later on to show you guys an inverted Nike tick, but it's basically the opposite of this, but upside down. So it's like the head here and then the tail is longer. So starting point here, ending point here, we always want to make sure that we're looking for this V shape. And an important point as well is that you want to make sure that it retraces fully the 100% here. So it has to fully retrace it and go beyond the 100% starting point. So you can see over here in this example, it has retraced more than 100%, and it has moved up to this projected level at the 161.8% level. Okay, so it's at this 161.8% projected level that we are expecting a reversal off of this level. And you can see that's exactly what it did. So not included here is the 127% level, which would be somewhere over here. So once price has broken out the level, then you can expect price to reverse off of the 161.8. Before it reverses off the 161.8, you may expect it to either break out of the 127 or like it did here, or also reverse of the 127 level. Okay, here is a GIF to show you guys what I mean. Okay, so we can see here price is currently at the 127.2% level. Okay, so if you watch closely, price did kind of test this level a bit before breaking out of it. And then once it breaks out of it, then we can expect a really nice bounce off of the 161.8 level. Okay, so let me know if you have any questions on the three Fibonacci methods so far. If you are a little bit confused, let me know as well. But we cover all of these in depth in our Fibonacci series. So not to worry if you are a little bit confused, if you've missed those. I think we will probably do those again sometime soon. So yeah, you can keep an eye out for that. Okay, let's move on. So next we're gonna be taking a look at Fibonacci projection. So we have Fibonacci projection actually uses the Fibonacci extension tool and not the Fibonacci retracement tool like the other two um that we've like the other three methods that we've looked at previously. So this is because the Fibonacci projection uses 3 points that only the Fibonacci extension tool provides. So for Fibonacci projection, we use the 61.8, 70.6, and 100%. It's mainly those three, but you can also use the 127.2, 161.8, and the 200%. Okay. Pro tip, once again, for Fibonacci projection, we are also looking for a flash or zigzag kind of shape. So very often the projection and expansion tools rather, the ones that both use the flash zigzag shape, those are typically used together to find a confluence area. Okay, now let's take a look at a couple of examples of this. Okay, so here's an example of a Fibonacci projection uh, analysis. So we have a starting point here, middle point here, and ending point here. And you can see very clearly this flash shape. So this Fibonacci trend line, as I mentioned earlier, should follow price movement really closely. So follow the shape of the market basically. Okay, so in this other example, we have the starting point, middle point, and ending point, and we are projecting this price to bounce off of a specific level. So we can see here we have identified this 78.6% Fibonacci extension. And this is extension we're looking at. As I mentioned, always look out for the zigzags. And you can see price really bounced off of this 78.6% Fibonacci extension. Okay, so here is the before where we are using the projection, Fibonacci projection. So it's a little bit confusing because the method is Fibonacci projection, but we are using the Fibonacci extension tool that's on MT4 and TradingView. So as long as you remember that projection uses 3 points, I think you're good to go. So starting point, middle point, ending point, these are the 3 points that we're using. Remember this shape, this zigzag shape, and then the 78.6% Fibonacci projection that we are expecting. Then you can see price really bounced off of this 78.6% Fibonacci projection level. Okay. Next, let's take a look at another example. This is another kind of shape of the zigzag. It's inverted now. So we have a starting point, middle point, and ending point that follows the shape pretty closely. And then we are projecting price to hit the 100% Fibonacci projection. So we say that the 100% level is one of the most powerful levels because price is most likely to hit those levels. Okay, and you can see that's exactly what happened. Price reacted off of the 100% Fibonacci projection level, just as we expected. Okay. Okay. Now that we know how to identify um, some Fibonacci levels, let's take a look at how you know when is considered an invalid Fibonacci retracement. So when does a Fibonacci retracement become invalid? So one of the most common scenarios of this is when price makes a lower low. So if they're assuming you are drawing Fibonacci retracement from the top to the bottom of the picture. So as I showed you guys in one of the GIFs, price made a lower low from, or rather, we're drawing the Fibonacci retracement from the top to the bottom. So that's what we need. So an invalid Fibonacci retracement happens when price makes a lower low. So the lowest point or the ending point is no longer valid. So that's just basically what it means. So if there are bars on the right that break your ending point, it then becomes invalid. So there are Fibonacci retracements that are negative. So the negative 27 and negative 61.8 that we use for Fibonacci expansion. And we'll touch on these as they basically go beyond your ending point and yet they are still valid. So we already talked about those in a couple of the slides before. So here's an example of an invalid retracement. So you can see the starting point here, ending point here, as I've highlighted. And because price has broken below my initial ending point, it then becomes invalid. Okay, as long as it breaks below the 0.0% level, it's invalid. Okay, so it's important to always remember to pick the lowest point with nothing to the right of your ending point. Okay, that kind of brings us to the end of our recap for the Fibonacci section. So let's get into the introduction for our Elliott wave theory now. Okay, let me know if there are any questions so far. Okay, seems like we are all good. So, Elliott wave theory is a really popular approach to analyzing financial markets, particularly in trading. So, it's based on the idea that price moves in repetitive patterns that's driven by investor psychology. So, it's developed by Ralph Nelson Elliott in the 1930s. And the theory suggests that the market movements can be divided into a series of waves that follows a specific pattern. So these waves reflect the alternating dynamics of market optimism. So those would be bullish phases and market pessimism, which would be bearish phases. So it's basically a method of analyzing cycles in the market. And by analyzing these price movements, you can then forecast future market movements. Okay, now let's get into the different types of waves. So the first type of wave that I want to touch on is, so this is what a typical Elliott wave looks like. So it's pretty theoretical, so bear with me in this part. So firstly, we have the impulsive phase or um, impulsive waves, or we even call these motive waves. So um many names for it, but it's basically the parts of the wave that are trending. So Elliott proposed that market trends consist of 5 waves in the direction of the primary trend, followed by 3 corrective waves. So these waves are known as impulse waves and are labeled with numbers 1, 2, 3, 4, and 5. So I have included in bullet points to show you guys just to make it a bit clearer. So wave 1, this is the initial wave in the beginning of the trend. So it's often seen as the beginning of a new move after the previous correction. So this wave 1 is typically not very strong yet. Next, let's take a look at wave 2. Okay, so after the initial rise of wave 1, there's typically a retracement or correction in wave 2. However, wave 2 doesn't usually retrace the entire movement of wave 1. Next, wave 3. So this is often considered to be the most powerful and the extended wave in the sequence. So it tends to be the strongest move in the direction of the trend and is typically longer and more dynamic than waves 1 and 5. Okay, so this impulsive phase, I forgot to mention, we're talking about the numbered phases here in the image that I've included. Okay, next, let's take a look at wave 4. So at the number 4, following the strong move of wave 3, there's another corrective wave in wave 4. Similar to wave 2, this wave retraces part of the movement of wave 3. So this is all leading us to the final wave 5. So this is the final wave of the trend and represents the last push in the direction of the primary trend. So it's often accompanied by reduced trading volume and can show signs of exhaustion. Okay, so next let's take a look at the corrective phase and the corrective waves that are part of this corrective phase. So those are the next part that we're going to be talking about are the lettered ABC areas of the wave. Okay, you can take a look in this image as well. It's not so crucial to follow exactly the percentage. So once again, these use Fibonacci levels, which is why I thought it was important to recap on the Fibonacci techniques earlier. But all of these percentages are from Fibonacci and it's important, but not crucial points for you to follow exactly the percentage of the retracement. Anyway, let's get into the corrective waves. So after the 5 impulsive waves are complete, the Elliott wave theory suggests that there will be a 3-wave correction against the primary trend. So these corrective waves are labeled with the letters A, B, and C. So wave A, this is the first corrective wave after the completion of wave 5. So it's a counter trend move against the primary trend. So you can see here wave 5 is upwards. Wave A counters that upward movement. Okay, wave B, after the completion of wave A, there's a partial retracement in the opposite direction, as you can see here. So the partial movement is about 50% or 61.8% of wave A. However, wave B doesn't usually retrace the entire movement of wave A. So again, about 50% or 61.8%. Okay, next we have wave C. So this is the final corrective wave and is often the most dynamic of the 3. So it moves in the direction of the primary trend and can be quite strong. Okay, so once again, the percentages are not crucial to take note of, but it's important to maybe remember some of them. But what's more important is the 3 main rules that I'm going to be talking about in the next slide. Okay, so here are the 3 main rules, and these are really important rules that you should remember. So you can ignore this wave 1, 3, 5 thing here, but 3 main rules that you cannot ignore. Firstly, wave 2 cannot retrace more than 100% of wave 1. Okay, next main rule is wave 3 can never be the shortest of the 3 impulse waves. Okay, so you can see from the image I've included here, wave 3 has to be longer than wave 1 and 2. Next, we're looking at wave 4. Sorry, I misspoke. Main rule 2, wave 3 can never be shortest of the 3 impulse waves. So the 3 impulse waves that we're talking about is 1, 3, and 5. So 1 has to be the shortest. 3 can be longer than 5, but it should not be the shortest. Okay, next. Point 3, wave 4 can never overlap wave 1. So it has to be, just follow the dotted lines here, can never retrace more than the head of wave 1. Okay, the percentage over here, the 1, 3, and 5 is not super important for you to remember. These 3 main rules are more important. Okay, now let's take a look at some of the shapes. So here I've included some examples of entry and some shapes that you can take note of. Once again, there are, if I'm not wrong, more than 50 shapes for Elliott wave and harmonics. So it's a bit difficult for me to include all of the shapes, but I have tried my best to include a couple of important ones for you to take note of. Okay, so here examples of entry. We have the simple M shape and the W shape. Okay, this M and W patterns over here are a bit blurry, but it's basically the same thing. So you can ignore that. So simple M, let's take a look at this. The entry point is between these 2 hits of the M here. And the bottom basically the corners of the shape M. So this is a simple M. When we're looking at an extended M, the extended M tends to be at the back of, or rather the second half of the shape. So it starts from the bigger half here to over here. So any point of this can be considered an entry point. Okay, next, let's take a look at the short formed M. Short form, basically because the second half is shorter than the bigger half here. But for this shape, the entry point is solely at this tip of the M here. If we're looking at W, it's pretty similar here. Excuse me. The simple W will once again take into account all of the corners, and any of these 2 points can be considered an entry. Short formed W, similar to the short formed M, only the tip of the M can be, or the W can be considered an entry. Extended W, the highest point or the highest tip and the middle tip can be considered entries. Okay. So here's an example of a W bottom. So you don't really have to take into account all of these bars. Just really want to highlight the type or the shapes over here. So example of a W bottom here, we have, if you compare here, we're looking at a short form W, and this breakout here is our entry, goes in, and our target or profit target is over here. That's why we say that this point here is your entry, because it's the point of breakout. Okay, if we look at an example of M top, earlier we mentioned, if I go back, we're looking at the short form M, where entry is only here. Same thing, breakout is over here at the tip. So this is our entry, and we're going in for a sell towards our target profit over here. Okay. Okay, if you are a bit confused with the shapes, I've included some images of them labeling the tips of the W patterns and the W patterns over here. Okay. So next type of shape here, we are looking at a bullish godly and a bearish godly. So the rules, in this case, we are kind of going into harmonics over here. But there are a couple of rules for this pattern compared to the previous M and W patterns. So for a bullish godly, um, the AB leg, which is over here, the highlighted red leg, should retrace about 61.8% of the leg XA. So that's where your Fibonacci levels come in. Then the BC should retrace the 38.2% to about 88.6% of XA. So XA is the first line here. So we're looking at BC now. And then for CD, which is the last leg of this shape, CD is at least a 70.6% retracement of the original leg. So once you have all of those rules that are in line, then you can expect to enter over here, going for buy towards perhaps the A over here or the C. Similarly, if we're looking at the bearish, all of these levels still stand, but instead we're going for a sell instead. Okay. So just another shape for you to kind of take note of if you are interested in harmonics and Elliott wave patterns, because there are a lot of patterns out there. Okay, next we're taking note of a bat shape now. So the main rules of the bat pattern are the AB leg can retrace between 38.2% to 50% of the XA leg. So the AB leg is over here, the second leg here, retrace 38 to 50% of this original leg. BC can retrace 38.2 to 88.6% of this second leg. And the CD leg can retrace up to 88.6% of the original leg. CD leg can also be an extension between 161.8 and 2.618%. So because this is a tick or a Nike tick that we mentioned earlier, a Fibonacci extension, so you could also use the Fibonacci extension over here in this shape as well. And this is the shape that I was talking about, the inverted Nike tick. Yeah, the same thing, the same levels apply, same rules apply here as well. Okay, so it's bearish because we would then be going for a sell here. Bullish because we would then be going for a buy after point D. Okay. And then for our last shapes that I will go through for today, we have the butterfly shape and the crab shape. So let's start off with the butterfly shape first. So we have the 78.6%, the AB has to retrace of the XA. The BC has to retrace 38.2 to about 88.6 of the XA as well. CD has to retrace 161.8 to 261.8 of BC. So once again, this is a Nike tick as well, or the Fibonacci extension. Okay, or the CD can also retrace 127 to 161.8 of the XA. Okay, then you're going for a sell after D. Bullish, you're going for a buy after the D. Bearish, on the other hand, we have the AB retracing 38.2 to 61.8 of XA, and BC over here 38.2 to 88.6 of XA, and CD 224 to 361.8.5 of BC here. Okay, or 161.8 of XA. Okay, so yeah, these are all of the shapes that I will go through for today. Let me know if you guys have any other questions. Like I mentioned earlier, there are a lot of shapes out there. But yeah, I'm just gonna go through a couple in this webinar because this was quite information intensive, I think. I hope you guys are still with me. Okay, let me know if you guys have any other questions. If not, that brings us to the end of our webinar. Thank you guys so much for joining me today, and have a great rest of your week. And yeah, I'll see you guys next week. Bye, you guys. Yeah, so these shapes are, let me go back. They are price action, yes. So it's kind of overlapping the price action and harmonics and Elliott wave theory as well. Okay, Jitnuka, that's good to hear. Thanks, Stanley. Okay, see you guys next week. Thanks, everyone. Bye, guys. Take care.